Hello, very good morning to all and happy Friday. Kelvin here again. Welcome to today's Daily Dose of Market Insights. Good morning. Today will be Friday, 18th of October 2024. So as usual, let's have a quick look at the disclaimer first before we start today's gist of Daily Dose of Market Insights. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so give me a couple of seconds just to make sure that everything is okay from the technical point of view. Yeah. Okay, let me do a check for a while. I think should be fine. All right. So yes, before we jump straight into that usual short-term technical outlook on those various broad-based cross asset classes that we tend to do on a very frequent basis or even on a daily basis, let's have a quick recap what has taken shape so far in terms of news flow, economic data releases. All right. So a couple of things, important things to share because there's a slew of them, starting from the European session yesterday. We do have the all-important ECB monetary policy over here. So that came in within expectation, where ECB actually cut by 25 basis point to bring the depo rate to 3.25%. So that is actually the third cut so far this year. All right. So in fact, among all the major so-called developed nation banks, ECB is the one that has a much more dovish stance. All right, much more dovish stance. So right now, what market is actually expecting is there potentially could be another 25 basis point cut penciled in the month of December in the next ECB meeting to bring down the depo rate to 3%. And what's actually reinforcing this particular cut is because during the press conference, which is the ECB Governor Lagarde, she actually confirms that this inflationary process is well on track over here. So Guardian's pretty much unchanged. And what's interesting over here is that he did mention that officials are still increasing worrying about weak growth. All right. But they are still expecting some kind of soft landing and no recession. So because of this no recession kind of remark during ECB President Lagarde press conference, the euro actually didn't plunge way beyond 1.08. So they touched the low about 1.08 against the dollar. Then thereafter it traded sideways. So that actually causes the so-called 4 week of dollar strength that is seen across the major currency to actually take a pause yesterday. And that also saw the sterling dollar, which has a very kind of a positive correlation with the movement of the euro, to actually stabilize at the 130 figure mark as well. So later we'll touch more about that technical configuration, which is very interesting, especially on the euro dollar. Okay, so that was actually yesterday key news flow during the European session. That means no big so-called plunge on the euro, i.e. no big rally in the dollar against the other major currency. And another particular news flow is more pertaining to the US dollar side of the equation. So if you look at the US dollar side of the equation, what we have over here is the retail sales. Why retail sales is important? Because we know that three-quarter of almost, not 100%, almost three-quarter of US economic growth is driven by the services sector, and the services sector actually has a potential direct cost and pull impact caused by retail sales growth. So retail sales growth on a month-on-month basis, yes, it managed to beat expectation of 0.4% year on year. That was printed for the month of September. Market is expecting 0.3%. and it actually surpassed 0.1% that was printed in the prior month of August. But we know that month-on-month basis is tend to be very volatile, it tends to be cyclical. So if you remove off the kind of a seasonality and a month-on-month cyclical impact, the year-on-year figure actually don't came in that great. Why? Because the year-on-year figure came in 1.7% year-on-year. That actually kind of weaker than the year-on-year growth that was printed in the previous month of August, which is at 2.2%. So if you look at the trend on the year-on-year trend over here, so that actually smooth up the monthly seasonality factor. Okay, give me a couple of seconds because it tends to get hang every time and then when I do this webinar. Okay, let's look for a while. Okay, so do notice that since July high of 2.9% year-on-year, the last 2 months of August and September, the growth, year-on-year growth has starts to plateau off. So it's more like a mixed reading rather than a very strong retail sales growth. So with this kind of mixed reading in retail sales, market participants are still expecting the US Central Bank to still embark on its interest rate cut decision cycle. And if you look at the CME Fed Watch 2, nothing really just changed much over here. So if you look at the current one, okay, current one, so the one on, sorry, not current, 7th of November, let's very quickly. So 7th of November, right, market participants are still looking for a 25 basis point cut. So after the release of the mixed retail sales figure over here, the odds actually increases to almost 90%. Okay, so what you could see over here is that how do I read this table for those who actually first time looking at this table very quickly. Is actually you go to this CME group or just type in CME Fed Watch 2 over here, Fed Watch 2. So basically what this tool is that CME, very good courtesy of them to actually compile it in a tabular form rather than we do the mathematical calculation. These odds are actually derived from market transacted instrument that is pegged with the Fed funds rate, which is the Fed funds futures contract. That means how market participants anticipate the Fed funds futures will be in the next few meetings. So it's actually derived from the Fed funds futures contract, and we know that futures contract there are various months. There's an expiry month, and based on the various month going forward, the CME Fed Watch 2 managed to do a calculation, and from there we get an implied probability what the market is actually expecting to assign a probability that whether the Fed will hike, cut, or pause in the next upcoming FOMC meeting. So that's a very simple form that I explained to you all. So based on the next FOMC meeting, which is on the 7th of November, the CME Fed Watch 2 is now assigning a probability of 90% chance based on whatever latest data that the market has really digest from, which is the retail sales data, and as well as other indirect data like from ECB monetary policy decision, to bring down the Fed funds rate to 4.5%. Current rate is at 4.75% to 5%. So that's actually a high chance of an implied only 25 basis point cut. Very low chance of 10% that are looking at a 50 basis point cut. So in fact, what you see a week ago was 83. So now it jumped up to 90. All right. So if you want to see going down forward, what will be the probability like from December, January next year, March, all the way up to October next year, we can look at one called aggregated. Okay, so aggregated over here, it gives us kind of a we call it a higher level view. So what we could see over here is that on the 7th of November, that's the 90%, bringing down to 4.5%. So market is still also assigning a high chance of 25 basis point cut before the year end, which is at 18th of December, to bring it down to 4.25%. So that's a chance of 72%. But thereafter, we see a bit of a mixed bag reaction over here. Why? Because this light blue line didn't actually shift down to 4%. So market may expect it to stamp at 4.25%, which is a chance of 56% during the January 29, 2025 FOMC meeting. So after 3 cuts in 2024, market is now expecting a potential pause in January. Then thereafter to resume its cuts back again by 25 basis point each on 19th of March, 7th of July, then followed by 18th of June. Then after a pause again in July and another 25 basis point cut in September, and it pause again in October next year. So all in all, when it comes to 29th of October in 2025, market is expecting the Fed funds rate to be reduced to 3.25% to 3.5%. So that is still a kind of a interest rate cut cycle, but nothing changed, still pretty much of a gentle cut cycle of 25 basis point cut each. So if you look at the FX market over here, it seems to me that the FX market has starts to actually price in a very dovish ECB. So that's what I could see the dollar index over here rallying past 4 weeks or so. Okay, it rallied past 4 weeks or so, and right now this rally managed to start at the 200-day moving average. So that actually explained also to us why the euro dollar didn't actually break below that did have a clear plunge below 1.08 level, and the sterling dollar managed to survive at the 130 level mark. And later I'll touch more about the dollar yen. The dollar yen also managed to didn't surpass very clearly the 150.20 pivotal resistance that we highlighted yesterday. So hovering at the 200-day moving average, acting as a resistance at 103.70. The dollar index RSI is overbought. And what's interesting over here is that based on the intermarket fundamental is getting the US 2-year treasury yield. So this particular line over here is the US 2-year treasury yield minus the 2-year spread of a equal weighted broad-based major economy sovereign bond yield, taking into account. So basically it's the 2-year treasury yield minus the 2 years sovereign average weighted sovereign the 2-year sovereign bond yield of the rest of the world is a weighted average taken from Germany, UK, Japan, Canada, Swiss, Australia, and China. And what you could see over here is that previously the dollar strength also moved in line with this spike up in the US 2-year spread against the rest of the world 2-year sovereign bond yield as well. So basically this move over here indicating that the US Treasury yield is trading at a higher premium against the rest of the other world. Okay, the weighted average from the other rest of the world. But this 2-year spread, US Treasury 2-year spread minus the 2-year spread of the weighted average of the major economy is now also coming at a resistance level as well. Over here, notice. Okay, at this 1.88%. So that's why yesterday we do see, okay, in fact it's over here. Okay, that it starts to actually form a lower higher. Okay, a lower high over here. There's a potential lower high, potentially at this point now it starts to turn down at this point in time. So with that, potentially we may start to see a bit of dollar strength being paused going forward based on the current news flow and how does it impact on the technical chart of the dollar index individually itself, and as well as based on this intermarket correlation with the US 2-year spread minus the 2-year yield spread of the weighted average amount against the rest of the world. All right, and also right now, earlier today, there's this verbal intervention from Bank of Japan, Finmin, the Vice Finance Minister that's in charge of the FX market, warning of a sudden move as yen hit the 150 mark range. So it seems to us that number one, we do have ECB officials saying that yes, there could be a high chance of another 25 basis point cut in Eurozone, but they rule out recessionary risk. So going forward in 2025, there may not be aggressive cuts going forward in the Eurozone. And mixed number in terms of the US retail sales. Yes, month-on-month retail sales, big expectation, but year-on-year, it start to show signs of lackluster growth. And with that, now we come in with another verbal intervention of Bank of Japan stating that the yen is getting kind of too weak as it's actually probed the 150 level. So all in all, if you put everything together over here, potentially it seems to us that things are now aligning for at least some kind of dollar strength pause after that very strong steep rally in the dollar index that was seen in the last 4 weeks or so. Okay, so that's for the FX market news flow. And today's news flow also here, very interestingly, is also pertaining to the US stock market as well. So for the US stock market, what we could see over here is that yesterday, there's the TSMC, which I mentioned as well. Why is it important? Because TSMC, even though it's not a US related company, but it has a positive influence to the US semiconductor stocks, especially one of the mega big cap stocks, which is Nvidia. As we know, that Nvidia is the number 2 weighted cap stocks in the Nasdaq 100 and as well in the S&P 500. So what I could see over here is that the TSMC actually rallied yesterday. It actually reported its latest earning after the close of the Taiwanese stock exchange, which is around Singapore time about 2:30 p.m. And it actually also boosted its target for 2024 revenue growth. So it gave a very positive guidance, very contrast with another related chip maker, major chip maker as well in this AI optimism boom that was seen in the last 2 years was ASML. ASML actually issued a weak guidance. But what interesting over here is that throughout the end of the US session, Nvidia didn't actually rally that much. So if you look at the current price, the price action of Nvidia yesterday, it actually only closed up by less than 1%, 0.9%. So what we could see over here is that then the rest of the other mega cap stocks also kind of lackluster as well. You see Microsoft only up by 0.14%, Apple 0.16%, Google underperformed, negative 1.34%, and Meta almost unchanged. You have Amazon over here only up 0.34%. So net overall, what we could see over here is that there's this continued underperformance of the Nasdaq 100 against the Dow Jones Industrial Average. So what you could see, like I explained in yesterday daily dose. So for those who missed yesterday daily dose, can actually take a look at our YouTube channel. Under there's this little compartment. I break down into chapter. Take a look at the fundamental and intermarket analysis chapter of yesterday's daily dose. I do explain clearly why at this point in time potentially the Nasdaq 100 could underperform the Dow Jones and the Russell 2000 from a multi-week perspective, and now it's playing out yesterday as well, despite we have a very strong indirect related positive news flow up from TSMC that failed to actually have a positive feedback loop back into the Nasdaq 100. So the Nasdaq 100 underperformed yesterday, almost unchanged, 0.08%, but the Dow Jones managed to close positive, with the top performer yesterday at 0.37%. The Russell 2000 a bit of pullback after the prior Wednesday strong push up of more than 1%. Closed down at negative 0.25%, and the SPX almost unchanged at negative 0.2%. So the reason why the Dow Jones actually outperform the Nasdaq 100 is number one, due to the bull steepening of that US yield spread between the 10-year and the 2-year that's in play, and as well as this ongoing Trump trade that is coming back into the picture, where his policy tends to support the banks, the financials, which is heavily weighted in the so-called net Dow Jones Industrial Average, okay, rather than the Nasdaq and the SPX, and as well as his tax cuts, his proposed tax cuts that will actually revirginate or we call it push up at least some form of growth into the localized US economy. So that could also benefit the Russell 2000 as well, given the fact that the Russell 2000 company derive close to 80% of the revenue flows from the US economy rather than international economy, where majority of the mega cap is dependent on. All right, so that actually explained the underperformance of Nasdaq 100 yesterday. Okay, and going forward now, another potential news flow that could also impact on the dollar yen over here is this Japan inflation data. All right, so Japan inflation data was released early today Singapore time at 7:30 a.m. So at 7:30 a.m. over here, what we see over here is that the inflation rate, okay, so the inflation, okay, the core, okay, so Japan, that's strange, that's inflation rate, core inflation rate, and inflation rate X food and energy. All right, X food and energy over here. So let's look at the core inflation rate. So core inflation rate over here is only including I believe that fresh food over here. It actually went down to 2.4% from 2.8%. All right, but that is not the rate that Bank of Japan is watching. In fact, Bank of Japan watching is the X food and energy. So this one is called the core inflation rate. So what the Bank of Japan wants is that they want the core inflation rate to stabilize at the 2%, which is did. So it managed to actually tick up higher to 2.1% year on year in September. So if you look at the trend of the core inflation, that is excluding food and energy, that managed to actually stabilize at above at the 2% level, and last month it inched slightly higher to 2.1%. Okay, give me a minute, a few seconds to actually get it out. So usually a bit slower. Okay, notice that since July low of 1.9, in the last 3 months, it starts to tick up over here. So what it actually implies over here is that potentially the core inflation rate in Japan, that is excluding fresh food and energy, starts to stabilize at the 2% level, which is BOJ what it wants. So once it starts to stabilize at this 2% level and it starts to slowly trigger upwards, that could actually be in line with Bank of Japan ongoing cautious normalization policy. That means next year, potentially there could be still a couple of interest rate hike coming out from Japan. But nevertheless, we also got to take into account of the potential globalized volatility as well. So the Bank of Japan official said, yes, I will continue to hike interest rate or normalize interest rate from decades plus of ultra we call it very, very low interest rate at the 0% level. I got to bring it up slowly and gently, but I need to take into account of the current volatility of the global markets. That means, i.e., if there is an ongoing risk on or risk off, I would say risk off environment at that point in time, the Bank of Japan may need to actually hold back their interest rate hike cycle. All right, but nevertheless, in terms of the current macro data right now, is actually supporting this ongoing gentle normalization interest rate hike cycle that the Bank of Japan is still embarking on. So that could also put at least a kind of a short-term dollar yen cap at around the 150 level mark later when I touch on the short-term technical outlook on the dollar yen. All right, and another news is more pertaining to China. So what I could see over here is that in China, right before the start of our daily dose, we do see a slew of key economic data that is coming out from China. Yes, the housing price index continues to plummet at negative 5.7 year on year, way below what was printed in the previous month of August, which is negative 5.3%. So what I could see over here is that the housing market in China continues to be like a sign of there's no light to the end of this very dark tunnel. So it represents a very clear and urgent measure that the China top policymaker got to actually come out with very, very fresh stimulus to actually jumpstart this housing, very, very lackluster housing market that is causing the crux of this deflationary risk spiral that is playing out in China. But what we could see very interestingly is the other key metrics like the GDP rate for Q3 came in slightly better than expected. Market is expecting 4.5%. It came in at 4.6%, but that's still below that 5% growth target. So there is a risk that right now the Chinese government got to introduce more fresh stimulus to actually meet that 5% target before 2024 ends in Q4. But what's interesting is that industrial production and retail sales managed to jump higher than expected and in the previous month. So industrial production managed to jump from 5.4% to 4.5% year on year in August, above expectation of 4.6. Retail sales also a remarkable jump to 3.2% year on year in September, way above 2.1% in August, and also above expectation of 2.5. And because given this rather three key growth metrics in China that managed to outperform expectation, especially industrial production and retail sales, that managed to actually surpass or overcome the negative feedback loop effect of the housing price index. And what we could see over here right now is the China related stock market actually rallied, which is the Hang Seng index up 0.8% right now, and even the CSI 300 is up 0.77%. But the housing price index, the CSI 300 real estate index is actually down negative 1.7%, reflecting the very weak housing price data. All right, so later I'll touch on more on the Hang Seng Index technical outlook, but overall, there's a bit of what I call positive feedback loop that is being seeped into the marketplace right now, pertaining to in general to the China stock market and directly impacting the Hong Kong stock market. All right. Yes, so this is the key data that I will share with you all for today in terms of news flow and how they impact the respective asset classes. All right, so now let me touch on one particular fundamental data right now, and as well as its intermarket correlation with the dollar yen. Okay, so this is more of a longer term perspective from a multi-week perspective. So let me start with this very interesting take over here. So we know that today it released the core CPI data, which is the ex-food and energy. It went up to 2.1%. So there's a slight uptick over here from BOJ target of 2%. Okay, so previously there was a deceleration over here. In this deceleration, everybody was kind of pretty much afraid that BOJ may not be able to continue its gentle normalization interest rate hike cycle, and it may even potentially starts to think about going back to ultra or commodity policy. But that fear starts to subside in the last 3 months as we start to see the Japan core CPI index, that's excluding fresh food energy, starts to tick back up above that 2% desired BOJ target. At the top over here is the producer price index, the factory gate index. So in fact, if you look at the factory gate index, the factory gate index since December last year and early January this year, it really starts to tick up as well, way before the tick up in the Japan core inflation that only seen in the last 3 months. So the Japan PPI has already give a leading indication, and based on past data, it actually lead before a up move in the Japan core CPI. Example over here, in August 2009, it lead first before the core CPI turn up in May 2010. Here as well in okay, where is it? Yeah, this part here in June 2016, before the Japan core CPI pick up in April 2017, and in this part area as well, there's this double dip in March 2020 and November 2020 before the core CPI starts to accelerate in February 2022, and right now it's happening again, where the Japan Producer Price Index starts to increase first or accelerate first in December and January December last year, January this year. Then thereafter, the Japan core CPI starts to stabilize after it decelerate in the early part of this year, and this stabilized in the last 3 months of this July, August, and now September, holding above that 2% target. BOJ inflation target. So what it means that fundamentally right now, there is a lower odds that the core CPI may slip down below 2%. Okay, based on so-called this lead and lag relationship between the producer price index in Japan and the Japan core CPI inflation rate, which is excluding fresh food and energy, and that could potentially increase the chances of BOJ continuing its gentle normalization interest rate hike cycle, could then in turn potentially slow down the dollar strength against the Japanese yen, and the Japanese yen could also potentially strengthen a fair bit from a multi-week perspective against the dollar. So this one aspect of it. And another aspect of it is by taking into account of the yield spread between the JGB yield and the US Treasury yield. If you look at this yield spread, for those who actually followed my daily dose on a frequent basis, I also use this as an intermarket correlation in line with the dollar yen rate. So what you could see over here is that the 10-year US Treasury yield minus the 10-year JGB yield spread. Previously, the dollar yen was actually pummeling as well, and since the low of September, around middle of September, the dollar yen also increased, and we see an increase in the yield spread between the 10-year yield spread between the 10-year Treasury yield and the 10-year JGB yield. But however, in the last 1 week or so, it refused to break above this 3.19% intermediate resistance. It paused here and did a slide. So it seems to us that the yield spread right now is coming to a ceiling between the 10-year US Treasury yield spread and the 10-year JGB yield. Okay, that means, i.e., the yield premium of the US Treasury yield may start to get narrower again in the weeks ahead. So that could also supports some form of dollar strength against the yen, taking a pause right now after seeing a rally in the last 3 to 4 weeks or so. And if you look at the shorter term tenure as well, but this is getting more obvious because this one is shaping a lower high already over here. Okay, this point. Okay, let me expand it so that you guys could see. Here, okay, a lower high, and this lower high is being formed right exactly at the previous breakdown point of 3.84%. Oops, let me Control Z. Okay, what is going on? Okay, let me go back again. Delete. Okay, briefly down. Okay, so it formed a lower high at the 3.84% and is now inching downwards. So indicating that the shorter tenure, that is more kind of sensitive to monetary policy of the both country. The 2-year Treasury yield spread against the 2-year JGB yield, that means the difference between the 2-year Treasury yield minus the 2-year JGB yield, is also narrowing downwards as well in terms of the premium of the US Treasury has over the JGBA on its 2-year tenure. So that overall could also potentially reduce or see some form of what I call dollar strength being halted against the Japanese yen at this juncture after rallying in the 3 to 4 weeks perspective. So net overall, we may see a bit of bearish reversion coming into the dollar yen from a multi-week perspective based on this fundamental and a intermarket dynamics that I'm sharing with you all today. All right, so very good. So that actually sum up today's fundamental and intermarkets dynamic. So now let us now jump straight to the individual technical analysis outlook based on a very short-term basis, which is the intraday basis on the various broad-based cross asset classes. But before that, let me expand my screen so that you guys have a better view on the key levels. All right, so let's start with the FX market over here. Okay, so starting with the euro dollar. Okay, so you know that the euro dollar yesterday, it didn't actually plummet below the 1.08 level. So what you could see over here is that yes, it went below the 200-day moving average, but it managed to hold above this medium-term pivotal support level at 1.078/1.0750. What is this level? Congestion area over here, July 2024, August 2024, and as well as this symmetrical triangle, major symmetrical triangle that is in place since July 2023, the lower limit of this major symmetrical triangle, which is the ascending trend line from the low of 3rd of October. Tested 1 time, 2 times, 3 times, and this area here, it forms the major pivotal support level. All right, over here. So what we could see over here is that we start to see a very strong push down in the last 4 weeks or so, okay, of 3% decline from the high of 25th of September. And this push down led the daily RSI, this is not the hourly, the daily RSI to be at its oversold region, and the Bollinger Bandwidth, which measures overstretch movement back at an extreme overbought, kind of at a overstretch condition as well by this steep move upwards hitting the red line upper boundary. So then overall, what it could means over here is that the steep decline that has taken shape in the last 4 weeks is now coming very close to a medium-term pivotal support level. Okay, and RSI, daily RSI oversold with overstretched decline condition. Potentially, this 3-4 weeks of decline may take a pause, and we may see at least some form of mean reversion rebound with the first resistance to watch at 0.95. So that is the daily chart over here. So what we could see over here is that going back to the hourly time frame, because this is where we structure our intraday technical outlook. So what we could do over here is that this is indeed a medium-term pivotal support that I derive from the daily chart. All right, so what we could do over here is that we could have a first support level to watch, okay, which was yesterday's low, okay, at 1.0814. Okay, so what you could see over here is that the RSI also starts to bounce off over here and start to shape a higher low, okay, at the oversold region. Oops. Okay, it start to bounce from the oversold higher low. First support 1.0814 is just slightly below the 1.08780/0750. So this will still be my pivotal support level. So it's like a medium-term pivotal support level. So using this as a pivotal support on an intraday basis, we'll flip to a intraday bullish bias from yesterday's neutrality stance. Resistance level to watch on the intraday basis. First resistance will be the 200-day moving average and this congestion area here, 1.0870 and 1.090. Right above it sees 1.0950, which is the minor swing high of 10th of October and 11th of October, and as well as the congestion area that's being formed on the daily chart that I share with you. But however, if price action starts to break down below 1.0750, then this intraday bullish bias for that mean reversion rebound will be invalidated to see the continuation of this impulsive down move to expose the next near-term support level on the intraday basis at 1.0710, followed by 1.0760. Okay, 1.0760, which is the minor swing low area of 14th of June and 26th of June this year, and as well as a Fibo extension level at 2.618. Okay, so that's for the euro dollar. Okay, now our focus on will be the sterling pound or the sterling dollar. Still recall that sterling dollar, we do have access pivotal support at 1.2980 over here, which is managed to survive. Okay, Okay, this level here. So still no change using 130/2980 medium-term pivotal support. Still maintain that intraday bullish bias for at least some form of mean reversion rebound that could potentially take shape on the sterling dollar on the intraday basis. First resistance level to watch will be at 130.40 that the market is testing right now. Above it, potentially sees 1.3107 next, which is confluencing with the 50-day moving average that is acting as a resistance level as well by this dark green line here. This is the 50-day moving average. Only a breakdown below 1.2980 invalidate today's intraday bullish bias to see the impulsive down move resuming on the downside, exposing the next near-term support level at 1.2940, followed by the congestion area of July and 14th of August at 1.2860 next. All right, so that's for the sterling dollar. Now, turning our attention will be the Asia Pacific currency against the dollar, starting with the Japanese yen. All right, so what I could see the Japanese yen over here is that after that verbal intervention earlier on this morning, we see that pause at the 150.20 short-term pivotal resistance that we highlighted yesterday. So still no change. And one interesting over here is that I want to share with you all, on a very short-term basis, this pink line here, taken from the low of 8th of October and yesterday's intraday high during the US session, it formed this kind of converging wedge. So we call it these two lines converge. All right, so we see that the white place getting smaller and smaller as it goes forward. All right, so this is considered as a bearish ascending wedge configuration as well. So indicating that last push up, that was the last few push up that was seen yesterday during the European and the US session, is losing upside momentum potentially. And what we could see right now in terms of the RSI, by drawing a parallel trend line support level, okay, it indeed shaped a bearish breakdown. Okay, some kind of parallel trend line support is shaped that tested one time, two times, three times, and during Asia session it break right now. So indicating a very kind of a lackluster upside momentum despite this ongoing red push up of higher high and higher low that's being printed out on the price action of the dollar yen, but it's not being supported by the momentum reading and the price pattern by the appearance of this bearish ascending wedge. So still no change here. Use 1.520 as my short-term pivotal resistance level, looking for a bearish bias on the intraday basis. First support level to watch will be this level that managed to survive on Tuesday and Wednesday at 148.95. Let me put it in writing. Okay, 148.95. A breakdown below 148.95 exposes the next near-term support at 148.10 next. Only a pushback up again, that means with an hourly close up again above 150.20, then this potential bearish bias on the dollar yen will be invalidated to see the continuation of this rally or mean revision rebound rally towards the longer term pivotal resistance area at 150.20, followed by 15150/95. Why this level is important? 15150/95 is the 200-day moving average, and as well as this dotted gray line here. So what's this dotted gray line? Very quickly on the daily chart, give you guys a quick recap, is in fact the former major ascending channel that was former major ascending channel support from the low of 16th of January 2023 now turns into a pullback resistance at the 151.95 level. Okay, so that's for the dollar yen. Now, turning our attention will be the Aussie dollar. So I could see the Aussie dollar right now. Yesterday, we do have a bearish bias. Yes, it came down, almost test the support level at 6670/6660 level. Can't break below this level and shape the lower low to test that 200-day moving average, and now starts to shape a rebound. And what you could see over here is that the hourly RSI continue to print a series of higher low. All right, over here, okay, it could print a series of higher low, indicating that some form of short-term upside momentum has starts to come back into the picture of the Aussie dollar. So with that, I will be using this 6670/6660 level as my short-term pivotal support level for today. Flip to a intraday bullish bias. Right now is attempting to actually retest this previous support now turns into a pullback previous resistance now turn into a pullback support around the 67.05 level over here. So given that momentum has started to turn positive, flip to an intraday bullish bias, near-term resistance level to watch for today, 67.70, which is the 50-day moving average, acting as a resistance. Above it says 67.70 level. So 67.40, 67.70 next. Only a price breakdown below 66.66, that means 66.60 short-term pivotal support level. If our hourly close below it, then we would resume this impulsive downward sequence to seek a retest on the next near-term support level, which is the 200-day moving average as well at 66.35. A breakdown below it says 65.95 / 65.75 next, which is the congestion area of 9th of August, 12th of August, and as well as 15th of August this year. Okay, so that's the outlook for the dollar yet. That's the short-term intraday technical outlook on the Aussie dollar, flipping to a short-term intraday bullish bias for today. Okay, now with that actually sum up the intraday technical outlook on the major FX pair. So let us now focus our attention to the major stock indices, starting with the Hang Seng Index or the Hong Kong 33. So the Hong Kong 33 today it actually bounces off exactly at the medium-term pivotal support that we highlighted yesterday as well. Still no change, 19,790 / 19,445. A bit of excess at the bottom because that actually comprises the Wooden ratio as well, taking from this very steep move all the way up from the low of 11 September right up to the high of 7 October. That is the 61.8% Fibo retracement level in the golden ratio at the 445 level very closely. So with that, still no change, using this level as my medium-term pivotal support level, 19,790, 19,445. We'll still maintain that intraday bullish bias, but first resistance you got to watch or got to clear will be the 20,850 level. All right, so this level is a very stiff intermediate resistance level that was previously support, break, can't break above it on Thursday before it on Thursday Asia session before it came down, and right now there's this little push up that's being formed, and net all you could see is that this bullish divergence continues on the hourly RSI, where price starts to shape a lower low, RSI higher low. All right, so still some form of supporting element from the RSI to maintain this ongoing bullish bias, but price action got to see a breakout of 20,850 to increase the odds of this bullish bias to test the next near-term resistance coming in on an intraday basis at 21,550 next. Only a breakdown with hourly close below 19,445 that will invalidate today's intraday bullish bias to see the continuation of this multi-week corrective decline scenario unfolding towards the or to expose the next near-term support level at 18,230, which confluence very closely with the 50-day moving average as well. So that's for the Hong Kong 33. Now on the Japan 225, so Japan 225 continues to remain holding above the 20-day moving average, and as well as this minor ascending trend line from the low of 30th of September. So with that, since there is actually two bounces since so far, yesterday and during yesterday's US session as well, I'll have this 38,740 from a proper risk management perspective, keep a bit tighter. 38,740 short-term pivotal support level, still maintain that intraday bullish bias within a minor range scenario that is still unfolding in the Japan 225 range. Minor range resistance will be at 39,580 level. Okay, so this will be the intraday resistance level to watch out for, given that it's coming close to Friday. All right, so now unless price action come down and break below this 38,740 for hourly close below it, then potentially this intraday bullish bias will be invalidated to see the extension of this choppy corrective decline sequence unfolding more towards the potential downside to expose the next near-term support level at 38,360, which correspond to the 200-day moving average, and as well as this medium-term ascending trend line taken from the low of 7th of September, all right, or 6th of September. Okay, below 38,360, then that will see a much more deeper correction sequence to test the next near-term support level at 37,815, minor swing low area of 30th of September to 2nd of October, and as well confluencing with the rising 50-day moving average. So that's for the Japan 225 intraday technical outlook. Now, turning our attention to the German 30. So the German 30 continues to shape higher high, and yesterday it managed to hit the first resistance level zone, which is the current all-time high level, 19,690 slash 19,775 area. All right. So given that the RSI now is coming, has really coming hit the overbought and now coming to shape that pullback, went below the 50 level mark and has still some more room to go before hitting the oversold level. So potentially there could be another chance of a pullback again taking shape, with the first support remains unchanged at 19,410 that has been tested 2 times so far this week. So having a slightly lower short-term pivotal support level, which also correspond very closely to this rising 20-day moving average as well. 19,320 remains the same as my short-term pivotal support. As long as this pullback didn't surpass below 19,320, we will still maintain that intraday bullish bias after that potential pullback takes shape. Why potential pullback may happen? Because of the RSI hitting the overbought level, and right now it actually inched down and went below the 50 level mark and hasn't hit the oversold region yet over here. And in fact, if you look at the Asia session, it starts to break below this kind of support level as well. Okay, so that's the risk of a pullback taking shape. All right, over here, 19,410, but maximum 19,320. So as long as this 19,320 doesn't surpass to the downside with no hourly close below it, we'll still maintain that intraday bullish bias after that potential pullback take shape. First resistance level to watch for sure, 19,690 slash 19,755. Above it sees the next near-term resistance coming in at 19,930. Okay, which is a 0.764 Fibo extension taken from the low of 11th of September. However, if price action starts to shape that bearish breakdown with an hourly close below 19,320, then today's intraday bullish bias will be invalidated to see the extension of the minor corrective decline, exposing the next near-term support level at 19,130. Break below it sees the minor swing low of 8th of October at 18,960, which also correspond very closely with this potentially rising 50-day moving average, which may soon come to act as a similar resistance support level as well at 18,960. So that's for the German 30. Now, turning our attention will be the major US stock indices, starting with the Wall Street 30. So still recall the Wall Street 30 yesterday, we still maintain a bullish stance, holding above the 42,630, and yesterday's strong push up managed to actually surpass the previous all-time swing high at the 4317 level over here. So now this will become a first support level to watch for today in any case of a potential pullback. Why? Because the RSI has started to exit from the overbought level already. But so far, the way it exit, there is no bearish divergence. Price action shape higher high. The RSI also move in a higher high sequence as well. Okay. All right. So first support level to watch in terms of any pullback will be at 43,170, keeping today a tighter short-term pivotal support level at 42,960 level. Over here, this former minor swing high now turns into a pullback support level, and as well as this ongoing minor uptrend phase that confluence with the 23% Fibo retracement as well. Okay, taken from the low of 8th of October all the way up to yesterday's intraday high. So as long as this minor pullback didn't surpass below 40 tighten key short-term pivotal support for today on the US Wall Street 30 at 42,960, we will still maintain the intraday bullish bias. Next resistance level to watch, 43,540, followed by 43,920 next, which is the 0.618 Fibo extension and the 0.764 Fibo extension taken from the low of 12th of September, and the 1.236 Fibo extension that confluence with the 0.764 Fibo extension. This is taken from an earlier swing low of 5th of August, which is the start of this minor ascending channel, or from 5th of August 2024. Okay, only an hourly close below 42,960, tighten short-term pivotal support for today, and a breakdown below it that will invalidate today's intraday bullish bias on the US Wall Street 30 to see a slight or the start of an extension of a minor corrective decline to revisit 42,630. Right now it's coming very close to a 20-day moving average. A breakdown below it sees a steeper corrective decline to expose 42,180 slash 41,950, which confluence with the minor swing low of 26th of September to 8th of October. So that's for the US Wall Street 30. Now, turning our attention will be the Nasdaq 100, which still kind of lackluster. Yes, yesterday it rebound, hit our first resistance at 20,406, can't break up higher, and now did that pullback. So still no change, 20,155, 20,000, that will be our short-term pivotal support level. Given the lackluster bounce over here, there's no point having a very tight support. We will get a kind of a whipsaw, and also confluence with the 20-day moving average as well. So as long as this 20,155, 20,000 short-term pivotal support holds, we'll still maintain that Nasdaq 100 bullish bias, but it got to clear fast above the 20,406 to give it a bit of impetus to shape a potential higher high for the next intermediate resistance to come in at 20,615, which is the minor swing high of 15th of July. But however, if price action fails to actually go up and break down below 20,000 short-term pivotal support level, then today's intraday bullish bias. Okay, I repeat, if price action can't go up and have an hourly close and break down below 20,000 short-term pivotal support, that will invalidate today's intraday bullish bias to open up scope for a minor corrective decline scenario in the first step, exposing the next near-term support level at 19,750/19,630, which confluence with the rising 50-day moving average and this congestion area here, 28th of August, 30th of August, and as well as the minor ascending channel support from the low of 5th of August. All right, so that actually, okay, let me delete this error. That sum up today's intraday technical outlook on the broad-based on the so-called major stock indices, pardon me. So now let us now turn our focus towards the commodities market. So very stellar, strong performance of gold XAU/USD that managed to move within our expectation, now hitting our resistance level 2,709/2,719, being defined by a FIBO extension level. So with that over here, we would actually right now potentially may see a kind of a pullback taking shape because the hourly RSI has really hit the overbought level again. So first pullback level to watch will be that former so-called all-time high at around the 2,685 level, now turns into a pullback support level. We will have a slightly tightened key short-term pivotal support for today, slightly below the 2,7685, which is 2,668. I don't use it so tight because this 2,068 confluence with this rising trend line, linking up the higher lows in place since 10th of October. So as long as this minor pullback didn't surpass 2,688, the next form of resistance level to watch will be at 2,735/2,737 over here, which is defined by the 1.618 FIBO extension level, as well as the 2-time FIBO extension level from different degree over here. So that's the next resistance level to watch for today after 2019. But there could be a risk of at least a minor pullback first because of the overbought reading that is being printed out so far on the hourly RSI. All right, so this is a kind of extreme overbought reading that previously over here that managed to see a pullback as well, and over here as well. All right, so but however, if price action starts to have an hourly close below 2,688, then today's intraday bullish bias will be invalidated to trigger off a much more deeper minor corrective scenario for that mean reversion decline to revisit the rising 20-day moving average, which confluence with the next near-term support zone at 2,645/2,637 next. All right, so that's the short-term intraday technical outlook on gold XAU/USD, still maintaining this intraday bullish bias with a tightened key short-term pivotal support now at 2,668. Now, turning our attention will be the West Texas crude oil. So the West Texas crude oil going to remains holding firm above the short-term pivotal support level at 70.10. And what you could see right now that the hourly RSI has managed to shape a bullish breakout as well, after printing a series of higher low in the last two sessions. All right, so still no change. 70.10 will be my short-term pivotal support level. Still maintain that intraday bullish bias within this range scenario that is still unfolding within the West Texas crude oil. First resistance level to watch will be 73.15. That's confluence with the closely with the 20-day and the 50-day moving average. Only a clearance above 73.15 will give it a higher odds or impetus for that bullish bias to see a further uptick towards the next near-term resistance at 75.30. Only hourly close below 70.10 will invalidate today's intraday bullish bias to see it sliding downwards towards 68.70. So 68.70 is in fact the minor ascending trend line that I drew from the low of 10th of September. A breakdown below 78.70, 68, okay, a breakdown below 68.70, pardon me, sees the further extension on the downside to expose the minor swing low of 1st of October in first step at 67.55/67.10 level. All right, so that also sum up the intraday technical outlook on all the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key events to look out for today? So for today, one key event that takes shape that may impact the short-term movement of the sterling dollar will be the UK retail sales. UK retail sales that out later at 2 p.m. Singapore time. And thereafter, it will be a rather quiet US session, except for a second level tier of data to look out for will be housing stats out at 8:30 p.m. Singapore time. And we do have two Fed officials speaking, Fed Bostic and Kaskari. I think that shouldn't really change much of their tonality. Still looking for a kind of a controlled inflationary environment in US that's really taken shape, and that could also support this ongoing interest rate cut cycle. But they may not sound so dovish in the past because unless one of them sees some form of very weak growth inflation, weak growth US data coming into the picture. So Fed Bostic and Kaskari speaking at 9:30 and 10 p.m. Singapore time. And we have Fed Wowler speaking at 12:10 a.m. Singapore time. And over here, yes, that's about it. What we could see over here is that an early morning Monday, Singapore time at 9:15 a.m. We do have a loan prime rate that is coming out from China, 1 year and 5 years. So do take a look at potentially this rate could be cut as well, given that there is a clear urgency for the China's central bank to actually introduce lower rates. All right, so something to look out for at 9:15 a.m. Singapore time on next Monday. All right, so with that, that sum up today's daily dose of market insights. I'm Kelvin here, signing off, wishing you all a great weekend ahead, and we shall speak again on Monday. Thank you.